Hello, everybody, and welcome to our May 2023 edition of GlobalView. For those of you who are new to Frontier View, we're part of Fiscano's Geopolitical and Market Intelligence business unit. At Frontier View, we work as a trusted partner with over 300 multinationals, supporting senior executives such as VPs of region, CFOs, and strategy leads. Our focus is on powering strategic planning, market monitoring, and international growth. And for that, we have dedicated practices for North America, Latin America, Europe, Middle East and Africa, Asia Pacific, global economics, and healthcare. We work with clients across a number of other sectors as well, such as consumer goods, B2B, and tech. For today's edition, I'm joined by Antoine Bradley, who is our analyst on our global economics research team and also specializes in the US. And I think we have quite a US highway conversation, but in this case, that is appropriate because a lot of global issues that companies are trying to plan for the rest of this year and really looking at 2024 plans as well. They start and end with the US and what's happening in terms of inflation and monetary policy in that market as well. We know that Fed hikes have been driving significant increases in interest rates and ultimately credit costs as well globally over the past year. And that has put pressure on currencies. It has affected government borrowing costs. It has had an impact on, of course, domestic credit costs as well across markets across the world. So what happens in the US really does matter right now from a monetary policy perspective and has multiple ripple effects down the line for countries around the globe. So wanted to start a little bit with kind of the source of that tightening, and that's inflation. Antoine, we've had a few more months of kind of US inflationary numbers. What can you tell us about how inflation in the US is trending? Is it slowing down? And broadly, how you think that factors into the Fed's assessments of what they should do next?
Yeah, absolutely. So the inflation in the US has been on a broadly positive trend if we're looking at it from a kind of a headline figure. If you look at the latest figure, it's at 4.9. If you think about where it was around summer last year, around 9%, that's an okay looking number, especially in the last 2-3 months. We've seen some big falls, so from 6 to 5 and then down to 4.9 in April. So what's driving that really is lower energy and food costs. We're seeing really some improvements in that respect. Some of that comes from base effects from last year, especially in March and April, where kind of if you look at the year-on-year figure, because of the spikes that we saw in February and March of 2022, that's kind of bringing the price growth down. We're also seeing low prices in the cost of other goods, such as used cars or just generally big ticket items from lower demand, improving supply chains, improvements in the manufacturing sector. There are some areas of concern, especially we're looking at services in the US where that's being fueled by high wage growth, and that is being fueled itself by a tight labor market. So we're looking very closely at labor market data in the US to kind of guide our thinking around the cost of services moving forward. Other parts of inflation, we see some positive outlooks, especially in the cost of shelter. Around the US, the cost of rent especially is starting to fall in a lot of major cities. That takes a bit of time to filter through into the headline CPI figure, but we think that will provide some important downward inflationary pressure. So broadly, we think that this trend is going to continue. We're likely not going to see stable 2% inflation until late into this year, if not early into 2024, and that obviously guides the Fed's thinking. So to that point, the Fed hiked recently down up to 5.25%, so another 25 basis point hike. We think now that the Federal Reserve is done hiking. This is a big moment in kind of the story of monetary policy around the world. We think that 5.25 will be the highest point that the federal funds rate reaches, and then the Fed will hold its rate throughout 2023 with cuts likely in early 2024. Now, this is because they really want to stamp out inflation, but they also don't want to hike too much and provide additional kind of pressure to the banking sector. And we'll go back to that point in a second.
Mm-hmm. So one of the things that, of course, you can see here as well that other central banks have either already finished their hiking cycles or are kind of on track to soon complete them. That opens the question of, well, when does cutting really start to take place? When do we start to see easing of those credit costs? And also, I would also flag for companies that are looking at next year's plans. Some central banks, especially in emerging markets, might come under pressure to cut rates just to free up slightly cheaper capital and to support growth as well. They might not be able to afford to stick with a high credit cost policy as long as the Fed does. And that's probably going to start to create additional pressure on currencies going into the rest of this year and 2024 as well. So it's something to watch quite carefully, because last year we saw so much simultaneous movement across central bank policy around the world. But I think increasingly domestic dynamics are going to start to really drive the choices central bankers make around timing and scale of those cuts, especially if the Fed really holds its nerve, as Antoine expects, and doesn't really hike for the rest of this year. That's a long period of time to wait if you're an emerging market central bank. But going back a little bit to credit conditions in the US, Antoine, obviously it's been now a couple of months since the SVB collapsed, and we've seen some additional ripple effects from it, but no systemic financial market crash, which was a concern back in March. Has this created a tighter lending environment in the US? How do you think about kind of the impact that might have on US growth as well? What are some of the lessons learned that we've seen so far?
Yeah, so you're exactly right. So we luckily have avoided kind of a full-on banking financial crisis. A lot of that's to do with kind of the state of banks in the US. They're much better capitalized now than they used to be because of stricter regulation, and that kind of has avoided a major panic. And we still saw some pressure amongst smaller lenders who are subject to looser standards. We saw, including the folding of First Republic, another small regional bank recently. But broadly, it's been relatively contained within the financial sector. The way we see this, but the impact of SVB's collapse materializing is more kind of in a slower manner and kind of rippling into the economy itself, and that's kind of through tighter lending. So in this uncertain banking kind of situation environment, we think that lenders will further tighten their lending standards, and that's to protect their balance sheets. It's more of a risk-off approach. That means it will be harder to access credit for both businesses and for consumers. And we think that will, be the biggest impact of SVB's collapse and resulting kind of situations. So there's certain kind of sectors that we're looking at, particularly where these tighter credit conditions will be particularly, pronounced. Office buildings, commercial real estate, that we think that will weigh on the economy. They will also weigh on manufacturing, and of course on the consumer side, as household finances have been eroded by inflation. Consumers will not be able to rely on credit cards as much as maybe they would have because of these tighter standards. So we think this is going to weigh on growth. We're still not expecting a full-on deep recession like we saw in 2008, but we do think that it will act as a drag on GDP growth in 2023 and early 2024 actually.
And one interesting point here is that this timing for the US is a little bit different from other major markets. So if you look at Europe, for example, we think that the weakest point in terms of the slowdown is probably right about now, Q1, Q2 this year, following a bit of a stabilization and maybe a modest improvement. Not a dramatic one, but on a slightly different timeline, a little bit ahead of the US. And then China, of course, is on a completely different trajectory, accelerating out of the reopening and out of some disruptions in Q1. Really seeing quite strong growth on a year-on-year basis this year as well. So that's actually beneficial from a global growth perspective, because you're not seeing all major markets slowing down all at the same time. We think will provide a little bit of resilience overall. But the thing that really, really matters when we look at next year's expectation is what happens to inflation, because that is going to affect purchasing power, price sensitivity, overall demand levels. It's going to affect trading down that might already be starting to happen in some markets. And it will also, of course, affect government budgets and what governments really are able to afford as well. So going back to the conversation about the Fed, Antoine, as we look a little bit longer term, do we think the Fed will cut rates next year? And if so, to what extent?
Oh, that's $1 million question. But we think that we are entering a different kind of era, if you will, of monetary policy, where the Fed will, yes, cut rates at some point in 2024, and we think that there will be, a sustained period of rate cutting. However, we don't think that they will fall back to the levels that we have seen, that we saw kind of post 2008 financial crisis up to the pandemic. Now, there's several reasons for that, but we think that there are kind of more structural kind of sources of inflation that are coming in, and which will mean that inflation will be at a structurally higher level. Now, what that Some of them include a restructuring of supply chains, a kind of decoupling and nearshoring trends, which we think will push prices up. There are certain demographic shifts, which mean that labor markets remain tight. That will provide upward sources to upward pressure to wages. Sorry, so we think, it's still a bit foggy, but we think that rates will fall to around 3%. That will be, we think, what the natural rate of interest is in the US. But again, it's hard to say at this point.
Yeah, and even that is already quite different, I think, from what companies have dealt with from a cost of funding perspective and also cost of credit for their customers over the past 10, 15 years. So we think it's going to reshape how companies think about their own profitability, the segments that they prioritize, the efficiency of their operations, maybe the customers that they target and prioritize as well. We've definitely seen action towards really going after more profitable customers and segmenting in a slightly different way as well. A lot of it starts here. It starts with some of the structural pressures that companies are going to be facing. So some good news, I would say, overall, but definitely not back to pre-pandemic normal. Even if we reach 2024 or that year, we're probably past the point of no return to the pre-pandemic era that we lived in. So a lot of food for thought. I hope that has been helpful to our listeners, and we look forward to seeing you again at next month's edition of GlobalView. Thank you.